So this week, the Federal Reserve announced 3 interest rate hikes as an effort to combat inflation in 2022. Local advisor Bruce G. Allen joins us live to talk more about how that will impact the economy. Good morning, Bruce.
Good morning.
So we have seen several months of increased inflation, and the Federal Reserve has continued to insist that this is temporary. Do they still think inflation is temporary right now?
Yes, yesterday was an about face for the Federal Reserve on a variety of fronts. What we saw was that the projections for the economy, both this year and next year, are so strong and that the inflation that you just mentioned is not just temporary, it's more permanent. And the unemployment picture is going to be so good by the end of 2022, we'll see unemployment down around 3.5%, that the Federal Reserve is shifting its entire focus from the economy recovering after the pandemic and helping the economy recover to fighting inflation.
So, Bruce, what does the end of bond buying mean for investors?
So the Federal Reserve, in order to help keep interest rates low, which helps economic growth, especially when we were coming out of the pandemic, has been buying long-term treasuries and mortgage bonds. That pushes down longer-term interest rates and helps keep mortgages, commercial loans, car loans, all loans of all kinds down in terms of the cost to consumers. Now that they are stopping their bond buying, they will terminate buying bonds in the United States by middle of March as opposed to June. So that will stop. And what that also does is sets up the stage for starting to raise short-term interest rates.
All right, and as you just talked about that, Bruce, so how soon and how fast will the Federal Reserve raise those rates?
The interest rates are likely to rise 3 times in 2022. So we're going to go from very low or almost zero interest rates to about 0.75% by the end of 2022. Those rates will continue to rise based on current projections to about 1.5% by the end of 2023. And by early the winter of 2024 and spring, we'll be back up to where short-term interest rates are likely at around 2%, assuming the economy unfolds the way the Fed expects.
So, Bruce, we heard from Jerome Powell on Wednesday. Can you explain why the stock market was up so much after those remarks?
I think the biggest thing that we saw from Jerome Powell was a very upbeat message about the economy. The economy in 2021 will be growing at 5.5%. That's the fastest pace we've seen in economic growth in the United States in decades. Not only that, but next year we'll see 4% plus economic growth, and inflation will likely subside. And so we're seeing very strong economic numbers, and we're seeing that the labor market, which will continue to be strong, we will be down to 3.5% unemployment. And think about that for a second. A year and a half ago, we were at 15% unemployment. And by the end of next year, we'll be down to around 3.5%. So the jobs picture and the economic picture is so positive, even with all the uncertainties around the pandemic, that the Federal Reserve, their message was, hey, we're going to shift to fighting inflation. And the stock market's very excited about that. They were very encouraged by the positive news about the economy.
All right, Bruce, well, we'll look to you to keep us informed on all this as we head into 2022. Thank you so much for being with us this morning.
Nice to be with you.